A leveraged ETF is a type of exchange-traded fund designed to deliver amplified returns based on the performance of a specific index or asset. It's like an investment tool on steroids, aiming to multiply the daily movements of an underlying index, usually 2x or 3x the gains or losses. How does it work? Leveraged ETFs achieve their amplified performance using financial tools like derivatives and debt. Instead of simply buying the stocks in an index, the fund uses strategies like borrowing money or trading futures contracts to boost returns. This means that if the index goes up 1% in a day, a 2x leveraged ETF is designed to go up 2%. On the flip side, if the index drops 1%, the 2x leveraged ETF would fall by 2%. Let's break this down with an example. Imagine a 2x leveraged ETF that tracks the S&P 500. If the S&P 500 rises by 1% in a day, the ETF's value will increase by 2%. However, if the S&P 500 falls by 1%, the ETF will drop by 2%. A 3x leveraged ETF would move even more dramatically, rising or falling by 3% for every 1% change in the index. Who uses leveraged ETFs? Leveraged ETFs are popular among short-term traders and investors who want to capitalize on quick market movements. They're not designed for long-term investing due to the way they operate, which we'll explain in a moment. Instead, they're tools for those who want to magnify short-term gains or hedge against specific market risks. The risks of leveraged ETFs. While leveraged ETFs can provide higher potential returns, they also come with higher risks, and it's important to understand these before investing. Daily resetting. Leveraged ETFs reset their leverage every day. This means they aim to deliver 2x or 3x the daily performance of the index, not its long-term performance. Over time, this can lead to what's called compounding effects, which might cause the ETF's returns to differ significantly from the index's returns. In volatile markets, this can work against you, even if the index ends up where it started. Example, imagine an index rises by 5% one day and drops by 5% the next. A regular ETF would likely break even over those 2 days. But a 2x leveraged ETF might end up with a small loss because of the way daily compounding works. Higher costs. Leveraged ETFs use complex strategies that come with higher management fees compared to regular ETFs. Over time, these fees can eat into your returns. Volatility risk. Because leveraged ETFs amplify daily movements, they can be very volatile. A small drop in the index can lead to a much larger loss in the ETF. Example of leveraged ETF in action. Let's say you believe a tech index is going to rise today, so you invest $1,000 in a 2x leveraged ETF that tracks that index. If the index goes up by 2%, your ETF will rise by 4%, turning your $1,000 into $1,040 in a single day. However, if the index drops by 2%, your ETF will fall by 4%, leaving you with $960. This amplified movement makes leveraged ETFs exciting for short-term gains, but risky for long-term holding. Benefits of leveraged ETFs. Amplified returns. They allow you to make more money from small market movements. No need for margin accounts. To achieve similar leverage with regular stocks, you'd need a margin account and take on debt. Leveraged ETFs offer leverage without that hassle. Easy to trade. Like other ETFs, leveraged ETFs can be bought and sold easily during market hours. Drawbacks to consider. Not suitable for long-term investing. Due to daily resetting and compounding effects, these ETFs can underperform over time, even if the index performs well. Higher costs. The management fees are higher compared to regular ETFs. Increased risk. Losses are amplified just as much as gains, making them risky in volatile markets. If you choose to use them, make sure you fully understand the risks and only invest money you can afford to lose.